You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to watching the Financial Survival Network. I'm Kerry Lutz, your host. Well, hey, we've got some Fed Speak event coming up shortly. And what the heck is going on with precious metals? They've been sinking like a stone. Let's talk with our good friend, Craig Hemke, tfmetalsreport.com. Craig, great to have you back on. So what is going on here and your take on things?
Well, actually, yeah. Gold's down, whatever it is, 8% year to date, and silver's obviously down far more than that. But then I look at it and I think, it's kind of remarkable that they're not down more, given what interest rates have done, given what the stock market has done. Given that the Fed has moved the way they have, and inflation expectations have fallen. I don't want to say surprising, and I'm not taking any solace off the fact that they haven't fallen further, but it's kind of surprising that they haven't. And I guess one of the things that's driving that is this kind of general idea that even that I'm in the same ballpark of that the Fed's going to pivot. So why dump your COMEX gold when you're just going to turn around and buy it back?
Yeah,
and that leads to the potential for kind of a little trap door type thing. And that's probably my greatest concern with gold right now, is everybody has watched support in gold, around 1,700 or just below. We've come down there 4 or 5 times in the last 2 years. And I think there's probably at least some supply of stop orders. They're down 1,650, something like that, where people go, I'll hang in there because the Fed's going to pivot and all that kind of stuff. But man, if we take out those lows, I better get out.
Yeah.
And that kind of becomes kind of a self-enforcing trade. So I worry about that, especially with, this FOMC looming for Wednesday. But for now, I'm just glad that we've been able to hang in there as well as we have, as frustrating as it's been.
So what about, remember, we talked a while ago about the physical floor for both gold and silver. Are we there yet?
Well, going back to 2014 through 18, it's pretty clear there was a floor for silver around $14. And even when, you just had this absolute collapse of everything when COVID was setting in, silver went down briefly below 14 on COMEX, and then it bounced. So, I think of course, anything can happen. You get some big margin call driven liquidity event like the financial crisis, and everything gets thrown out, right? Anything with a bid gets sold. And so anything can happen. I think silver is at least closer to or has already seen its lows, which again, that's no bargain. It's down from 27 to 17 at its lows. So it's not like, hey, yippee, we've seen the lows. But that and the commitment of trader structure, the chart in silver looks like maybe, worst case, a double bottom below 18. But I'm still worried, though, about gold running those stops, kind of like it did in 2013, where we bounced along finding support about 1550 for a year and a half. And then once that was taken out, gold fell a couple $100 in 2 days. I'm not sure that would happen again, but you could still get kind of a brief drop. And so that's my concern there. In the end, though, and Kerry, as we've only discussed on countless occasions, the Fed and the other central bankers are left with really a kind of a binary choice. They keep hiking and watch and get overwhelmed by a complete collapse of all the global markets and lose control of the treasury market and everything else, or they step back in and try to keep the plate spinning. I think it'll be the latter, but who knows how much damage can get done across all markets before they do.
Yeah. Yeah, well, that's what I've been saying. They had to make a choice whether they let the dollar go to nothing or they kill the economy and the stock market. And for now, it appears that they've chosen the latter and not the former.
Right.
At some point, right?
Right. Well, and again, my biggest concern, here I'm listing off all these concerns and calling my biggest one. Maybe I should state it this way. What bothers me the most is the treatment in the financial press. It's almost a complacency, really, between the financial press, the investment banks, financial advisors, individuals, that the Fed and the Fed officials are somehow these omnipotent demigods that have everything under control. When, you don't have to look back very far to find they don't know jack about jack. It was a year ago that inflation was transitory, right? Not a problem. It was 2 years ago that deflation was the problem. And so this notion now that, oh, don't worry, the Fed's got it all under control, as if Powell just has to flip a few switches and spin a few dials, engineer his little soft landing, and then unflip the switches and unspin the dials, and everything just goes back to being hunky-dory. It's a little more complicated than that. But yet this complacency across the markets of everyone thinking, no, it'll be just fine. And it probably, I don't know. I think the world's a little more complicated than that.
So looking at the war in Ukraine, one would think that this should have been very bullish for gold, and yet it's been the opposite.
Again, it's more complicated than just that, right? Look, I'm not trying to be like an apologist for gold, but again, gold is priced through the trading of derivatives, the futures contracts, and that is the tail that wags the physical price dog, if you will. So in the end, it's about supply and demand of those futures contracts. And right now, there's not much demand because real interest rates have risen, nominal interest rates have risen, the dollar has soared. And so even, the stated level of inflation is north of 8%, and we got geopolitical conflicts everywhere, the hedge funds, the main buyers of the futures contracts, are actually shorting gold and shorting silver. Not gold and not the physical, but the futures contracts, because they look at it as just a dot on a screen. So I don't know. Like I said, I don't mean to be an apologist for the metals and say they should be doing better. But again, there's a certain reality we have to face of how the price is discovered, and that's what's working against us at present.
Mm-hmm. All right. So you think this thing's going to be temporary, or is this going to drag on for a bit?
Well, Kerry, that becomes kind of the magic question, right? I'll be curious to see what Powell says on Wednesday, because this is the bullets I take for the people on my site. I actually sat and watched Powell at the July FOMC in his press conference. I actually had to sit there. It's a little bit like, remember that scene in Airplane where the guy's going on, and pretty soon the lady sitting next to him is like hanging herself. That's kind of how I feel watching Powell at his press conference. But he said, I quote, and I was watching the markets when it happened. He said, in the past tense, we have moved expeditiously to the neutral rate. There's no way that can be misconstrued. He said, we have moved expeditiously to the neutral rate, and now we will be data dependent going forward. And with that, gold shot about $20 higher, and then it continued on about $70 higher in the weeks that followed. The S&P went from 3,800 to 4,100 or something like that, because that's what he said. And now it comes out in the Wall Street Journal yesterday that the reason he gave a complete 180 at Jackson Hole 4 weeks later is because, again, the stock market rallied instead, and they're trying to drive this reverse wealth effect by inflicting losses, their words, and pain, their words, on investors. And so he does a complete 180. Well, if anything shows them to be totally untrustworthy and you can't believe a word they say, well, it's that little episode right there. So I don't know what he'll say tomorrow, and I don't know how long this game will continue. And again, they're treated as these demigods that are in total control and everything's fine. And maybe they're not. The 2-year note's up to 4%, 10-year note's over 3.5%. And who's buying treasuries right now, Kerry, if you're to believe them? The Fed's not. The ECB's not. The Bank of Japan isn't. The Chinese and the Russians aren't. So if nobody's buying, you've got nothing but sellers and new issuance from the Treasury and everything else. Who's to say they don't lose control of the bond market, in their obstinance and we've got this. Well, what if the 10-year goes to 5%? What does that do to the stock market? How quickly does everything just do one of these deals? like 2008. I mean, all of that's on the table. And so I don't know. I don't know how quickly they switch course. They will. I mean, I think that's a certainty. I just don't know how bad it's going to get before they do.
And how are they going to do it? They can't just come out and say, well, everything's different now. Everything's collapsing and we're changing everything, right? So what do they do? That's really...
Well, it's an admission, finally, that I think there's no turning back from. That we've had, when the Fed has made these admissions in the past, whether it was March 2009, or was it, 2018 or 2020 with COVID, everybody rushes into gold and silver for a while. Gold goes up 50% and the miners double or triple. And then everybody goes, nah, that's it. And they start moving back out and go into whatever the next hot asset class is. One of these times, they're not going to go back out because it's a recognition that, there's really no going back. And I think that's where we are this next time. I mean, Kerry, every subsequent QE program has been larger in size. It was $600 billion, the first one. And by QE, 3, it was 1.1 trillion. And by this most recent one was like 4 or 5 trillion. Well, that's just the, law of compounding interest, and exponential growth. So the next QE program to get rates back under control and keep all the plates spinning is going to be 7 trillion, 8 trillion?
Can't even imagine.
Right. And then at that point, why would anybody play along and think, the balance sheet's going to go back to normal, Kerry? The Fed tells us that they're going to normalize rates and they're going to liquidate. Come on, man. How many times are they going to get away with that lie? I get 6. I mean, it's been 3. I don't know. So it will happen. It will drive another tremendous bull market. And I just wonder if the next time it doesn't have a lot more staying power.
Good question. Well, I guess we are just going to have to wait to see the answer. What about all of Putin's rumblings about changing the reserve currency and all that? Really, I can't see Europe going along with it because they're already in disaster territory. Changing the reserve currency now would completely destroy the continent, in my opinion. Everything kind of hinged to the dollar.
Don't just survive. Thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Right. I don't think it's that stark. I've never really thought it would be that stark of a 1-for-1. We're going to, we went from the pound to the dollar at the end of World War II. What I expect and have expected since I started my site a dozen years ago is an offering of an alternative. And I think that's what has been worked on since 2011 and is now moving at instead of a glacial pace or a snail's pace, more of a tortoise pace. It's just picking up speed. Whether it's the new Moscow Bourse and the Moscow gold pricing and combined with the Shanghai Gold Exchange and everything that the Chinese are doing and the Indians accumulating more gold, and this BRICS coalition, Shanghai Cooperation Organization, I will see value in offering some type of trading instrument, currency to facilitate trade that isn't dollar based. Because with Ukraine in particular, the Fed and the U.S. the U.S. showed their hands. Said, look, we'll sanction you. We'll kick you out of SWIFT. We'll freeze all your foreign currency reserves if you don't do what we like, if you do something we don't like. Well, those countries, especially the Chinese went, okay, well, we see how this, we better do something so we have an alternative because we have our goals too. And they may run counter to what the U.S. wants. So I don't see it as a one-for-one swap of reserve currency. I just see it as competition for the dollar. And if you, in the end, it works out to be the law of supply and demand. If there's less demand for dollars because of the petrodollar recycling scheme or foreign currency reserves getting plowed back into treasuries, there's less demand for dollars and more supply of dollars, value of said dollars goes down.
Yeah.
And no amount of Fed rate hikes are going to fix that.
And maybe the whole Ukraine war is really about this. Might be a subterfuge for it.
Or a symptom of it all.
Yeah.
Yeah.
Certainly a symptom that, hey, your reserve currency, it's like Bitcoin. All right. It can't be a reserve currency because of its volatility, lack of stability. If it went up 5% a year, that would be fine. But instead, it has these massive swings. So it can't be a currency. One of the main things for reserve currency is stability. So if everybody's going down the tubes at the same rate, then everything looks fine. But really, stability is going to be what brings in the new world reserve currency. It's going to have to be much more stable than a U.S.
Right. And backed by something too, Kerry, so that it has confidence. I mean, that's why the dollar assumed that role in 1944, because the U.S. had 25,000 tons of gold. Yes. And it was convertible into gold. Okay, now we have confidence in using this to facilitate global trade. I have no doubt and never have had any doubt that to create demand for your alternative currency, you're going to want to back it with something versus the unbacked fiat of the West. And whether that's gold or a basket of gold and commodities or whatever, I mean, I that just seems logical, that you would give it a boost. You'd create demand for it by making it look preferable versus, the current system. And that, again, which is all part of why I'm sure you own gold. And that's why I own gold, is because I see that as an inevitable outcome.
It's inevitable, but that doesn't mean it's going to happen quickly, right?
Right. That's the thing. And maybe we don't want it to happen quickly, Kerry.
Yeah.
With the unrest that would follow.
Yeah. So true. So true. Well, so what should your average investor be doing right now in light of everything we've talked about? Because the stock market's not looking great, but at some point they will pivot and then it'll have another bull run, right? So do you just put into cash and wait for inflation to eat up your cash? Or is there an intermediate step that you can take?
Well, history is full of examples of the best performing stock equity markets in the world being ones that are being inflated and hyperinflated, whether it's Venezuela or Weimar Germany or whatever, right? I mean, you're just creating look at what the stock market did, from March 2020 until, whatever, late last year. All this cash gets flooded out and it's looking for a home and bids up, all these prices. In the short term, though, and in terms of the average investor, as you say, I mean, the average investor doesn't own any gold, doesn't own any silver. I mean, it's a pretty small percentage. So I don't even want to talk. I mean, they should, but they don't. I'll just talk. If you're listening, to this discussion and you've got a 401k plan or you rolled it out into a self-directed IRA and most of your assets are in some type of fixed income, blend, 40% bonds and 60% stocks, because that's what your stockbroker told you to do. And now's the time to be wary. I mean, you've already taken pretty substantial losses in the bond side of your portfolio as rates have risen, and they may go even further, and the Fed may lose control temporarily. So your bond portfolio is going to suffer more losses. Maybe not too much, because eventually those bonds are going to mature, come back up in value, and be paid back off at par. But it's a stock component that I think should worry people, because there's a complacency there. A little bit like gold, like I was saying. People are like, well, I'll just keep holding our stocks because the Fed's going to pivot and all that kind of stuff. If we're now moving down through 3,900 S&P, which means the door is now open to drop back to the lows of June. And just as I was comparing, gold prices and holding this floor near 1,700, because everybody sees I'll put some stops under there just in case. Same thing could be said for the stock market. Equities start making new lows in the S&P, for example, below the 3,650 or so level that we saw back in June. You could get some pretty quick liquidations, margin call induced liquidations, where everything starts getting sold. there should be some support below there. Maybe about the 200-week moving average, which is just below 3,600 in the S&P. But even that, I mean, as we record this, what are we like 3,850?
Yeah, right.
So that's that's 5% or so down from here. But I'll give you one last thing to chew on. Since QE began, you remember when the S&P bottomed out at 666? Remember that in late 2008, early 2009?
I'll forget it.
If you pull up a weekly chart of the S&P and you go back to that date, 14 years ago, there's a pretty easily discernible trend line that goes up. And you mark that trend line with lows. And all of those lows are associated with some sort of Fed pivot or some new Fed QE program that then bounced it off the lows and up it went further. This is 14 friggin' years. Now, I don't know how exactly or precise you want to draw that line, but that line today is down around 3,000 in the S&P. So what I'm saying is to get the S&P back to a level, equal to where it has bounced before or has led to some change in the Fed, the S&P could fall all the way down to 3,000. Well, 3,000 from here is about another 25%.
Disaster.
So long answer is, if you're in your 401k, your IRA, I hope, you better be wary of a 20 or 25% drop from here in the stock market, because it's certainly possible before the Fed pivots.
Great point. All right. Well, we appreciate your insight here, Craig, into what exactly is happening, because, the average person looks at it and you just can't make head or tail. Nothing seems to be working the way it should.
Right.
I mean, when you can buy a car and it's worth more money when you drive it out the lot than the way it used to be, where it was worth 25% less the second you drove it off the dealer floor, something is really crazy about the economy.
Yeah. When your neighbor across the street on both sides doesn't own their house, they're basically renting it from BlackRock, because BlackRock has bought up all the retail home supply. That's a whole brave new world too, my friend.
Yeah. Well, I bought a house because I knew that this was going to happen, the inflation. And we just need to talk about that. I absolutely knew. I mean, I was in a panic to buy a house because I knew they were going to go up massively. And one of my better calls in life, and I've had plenty of bad ones like all of us here, but inflation. So 4%, 5% interest rates really going to tame the inflationary dragon?
Depends on what you think is actually causing it. If you think it's just a demand-driven thing like the Fed, maybe. But I think it's more of a dollar supply issue, and everything else that goes with it. So no, in my book, no, it won't.
Right, which is exactly why I told people go and get whatever free money they're willing to give you, because you're going to be paying for it anyway in terms of higher inflation. This is exactly, I can even point to the YouTube video. I was telling people how to go for these PPP loans and everything. And it worked out exactly the way I said. Exactly here, Craig.
And probably will continue to work out that way, Kerry.
No doubt. No doubt. This is true. Hey, we appreciate you coming on again. Go over to tfmetалsreport.com. And
I think most people listening can tell I'm no ordinary gold bug. In that, if you want to use that, a lot of times that term is used derisively. If you're going to follow gold, man, it's not just a plot on a screen with waves and all this other crapola. I mean, there's a lot that goes into trying to assess where it goes from here. And that's what we do at my site.
So true, man. And of course, your forum, your community is really the leading PM precious metals community out there. So
thank you.
Done incredible work there, because it's not easy to do that.
Thank you. Well, I appreciate it. Yeah. The community is global, and look, we all recognize we're all in the same boat, right? So there's no safe harbor, and we've just got to kind of help each other get through it. And that's what the community of my site does too. So I'm really proud of it. And anyway, thank you for the kind words. It's a great online spot.
we're all in the same boat, and we're all bailing, trying to stop from sinking. Right?
That right. You got that right.
So true. Hey, if you've got a question for Craig, shoot me an email, kl@kerrylutz.com. Also, Craig would like to know, what are you doing? How are you trying to build your fortress, if you will, trying to get ready for the inevitable Fed pivot? Have you dumped your gold, or are you buying more? Just drop us a note. Let us know. We'll talk about it online next time. Craig, we'll talk to you again real soon. Thanks so much.
You bet, my friend. Always good to see you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.